Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 211 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about the Great Depression. Now, why are we talking about the Great Depression? Well, I want to spend some time this week talking about financial collapses of the past, and then things we can learn from those financial collapses to better enhance our future. Because with everything that collapses, there's always some rebuild and there's always some lesson that we take away. And very often there are lessons that we forget. And I don't want us to forget some of the lessons from some of the greatest economic meltdowns that the United States has ever seen. And so I'm going to go through 5 of them over the course of this week. And hopefully we can learn a little bit from each one. And you'll also notice that each one does have a little bit of overlap in it as well. So tune in for all that and more, but stick around for today's episode as I talk about the biggest of these in the form of the Great Depression. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So like I said, I think we can learn a little bit of something from just about every economic collapse that has come and gone. And we're in the midst of something economically now that we're trying to dig ourselves out of as a country that came from the coronavirus pandemic. And we'll talk a little bit more about that in Friday's episode. But we are going to start this week with the Great Depression. Now, what was the Great Depression? Well, the Great Depression was the greatest and longest economic recession in modern world history. Now, we have talked about recessions, and I've alluded to the things that may have been root causes of the Great Depression. We'll dig more into that in today's episode. But if you remember, a recession is basically contracting growth. Right? Some people call it, more than 1 quarter consecutively of negative GDP growth. That has been a historic measurement. Now it may be measured a little more by unemployment or other types of metrics that may show some, financial tightening or some contracting of the economy to where we are not growing, but we are contracting over time. Now, the Great Depression began with the U.S. stock market crash of 1929, and it did not end until 1946 after World War II. Economists and historians often cite the Great Depression as the most catastrophic economic event of the 20th century, and many would agree. But the beginning of the Great Depression was that stock market collapse. And so what exactly occurred with that stock market collapse? Well, the stock market crash of 1929, it began on October 24th, 1929. Now, while it's remembered for the panic selling in that first week, the largest falls occurred in the following 2 years as the Great Depression emerged. Okay, in fact, the Dow Jones did not bottom out until July 8th of 1932. So we had from October of 1929 all the way until July 8th of 1932. Right, this is a long period of time for the market to fall. Now, there weren't as many participants back then as there is now. The market wasn't as liquid as it is now. Information wasn't as readily available as it is now. But still, for the market to fall so steadily for so long is pretty amazing. It fell for almost 3 whole years. And by that time, it had fallen 89% from its September 1929 peak. Now, just think about this for a second. Could you imagine the Dow Jones that we know today falling by 89% in value, right? We saw the S&P 500 last year fall by over 30%, in the midst of the coronavirus, when we were just learning the impact that the pandemic would have on our lives over this last year and year and a half now, I guess, right? But that is, panic selling to us today. But back then, right, things fell in a much different way, right? And things were so bad between 1929 and 1932 that the stock market had to price in the fact that things were so bad economically in the United States. We could not imagine an 89% drop in our stock market. We would think it was the end of the world. And I think many people back then did as well. But this is where we started as far as the Great Depression. Now, the stock market crash of 1929 followed a bull market that had seen the Dow Jones rise 400% in 5 years. 400% in 5 years. That is a huge move upward. That's 80% per year average. Okay, but with industrial companies trading at price to earnings ratios of 15, valuations did not appear unreasonable after a decade of record productivity growth in manufacturing. That is, until you take into account the public utility holding companies. By 1929, thousands of electric companies had been consolidated into holding companies that were themselves owned by other holding companies, which controlled about 2/3 of the American industry. 10 layers separated the top and the bottom of these complex, highly leveraged pyramids. And that's something you'll find throughout the course of this week, is that leverage is a common factor in all market crashes. Leverage, or debt, right? Leverage is just this fancy word for debt, is going to be something that can accelerate growth, right? Which is why we're able to grow so much, which is why you're able to see in this type of situation where the Dow rose 400% over a 5-year period, but it also accelerates drops. That's why you saw an 89% fall in the Dow Jones between 1929 and 1932. But as the Federal Trade Commission, the FTC, reported in 1928, the unfair practices these holding companies were involved in, like biking subsidiaries through service contracts and fraudulent accounting involving depreciation and inflated property values, they were a menace to the investor. And the Federal Reserve decided to rein in speculation because it was diverting resources from productive uses. The Fed raised the rediscount rate to 6% from 5% in August of 1929. That is a move that some experts say stalled economic growth and reduced market liquidity, making the markets more vulnerable to rapid price drops, which we absolutely saw those rapid price drops. Another factor that experts cite that led to the 1929 crash is the overproduction in many industries that caused an oversupply of things like steel, iron, durable goods. When it became clear that demand was low and there were not enough buyers for their goods, manufacturers dumped products at a loss and share prices began to plummet. And we know that just based on simple supply and demand, that if the supply of something is really high, right, that shifts that supply curve to the right, which decreases our equilibrium price, which decreases the price at which you can sell something. And sometimes things have to be sold at a loss just to get them off of your hands. And that was the case here. Okay, so these were some of the things that led to that market crash, and that really allowed us to move into that place of the Great Depression. Now, the U.S. economy tailspin that came from the Great Depression, and from that, stock market overinflation and leverage and all these types of things, it was also multifaceted. Now, the stock market crash wiped out nominal wealth, both corporate and private, and sent the U.S. economy into a tailspin. In early 1929, the U.S. unemployment rate was 3.2%, which is historically extremely low, right? And by 1933, it had soared to 24.9%. So think about that. It went from 3.2% to 24.9%. Yes, we saw a huge spike in unemployment last year too by the forced shutdown of the economy, right? But we're seeing that jobs are being recreated. Now, maybe not at the pace at which we wanted jobs to be recreated, but jobs are still being created and people are going back to work, and we are getting back to a lower unemployment number than we had previously seen. But we didn't see anything like a relatively sustained 24-25% unemployment rate like was seen in 1933. Despite unprecedented interventions and government spending by both the Hoover and Roosevelt administrations, the unemployment rate remained above 18.9% in 1938. So even though this began back in the late 20s, by 1938, the unemployment rate was still over 18%, which is crazy, right? The real per capita GDP was below 1929 levels by the time the Japanese bombed Pearl Harbor in late 1941. Okay, so this, again, is crazy. We can't imagine now a 12-year period over which our per capita GDP actually declined, and that was the case here. While the crash likely triggered the decade-long economic turndown, most historians and economists agree that the crash alone did not cause the Great Depression, nor does it explain why the slump's depth and persistence were so severe. A variety of specific events and policies contributed to the Great Depression and helped to prolong it during the 1930s. And you would expect this, right? You would expect, especially knowing what we do now and how things don't last as long now, you would expect that there were policies that kept pushing things further and further in the wrong direction. So Let's talk first about some mistakes that were made by the Federal Reserve. And if you'll remember, at this time, the Federal Reserve was very, very young. Now, the Federal Reserve is what? It is the central bank of the United States. They make the monetary policy decisions. They make decisions to raise or lower interest rates. So when interest rates are higher or lower, that's the people you need to talk to ultimately, right? They keep an eye on unemployment, right? They're trying to keep stable prices and they're trying to keep low unemployment. That is their mandate, right? But the Federal Reserve was relatively new, right? They mismanaged the supply of money and credit before and after the crash in 1929. Created in 1913, the Fed remained inactive throughout the first 8 years of its existence, right? So from 1913 to 1921, they really didn't do much. After the economy recovered from the 1920 to 21 depression, the Fed allowed significant monetary expansion. So the total money supply grew by 28 billion, a 61.8% increase between 1921 and 1928. And we're seeing that now, right? We see this increase in the money supply. We see the increase of dollar bills that are being circulated in our markets. Money is coming in a crazy rate. Now, it's coming in a different way than it was then, right? It's coming in now via the purchase of treasury bonds and the purchase of high yield corporate debt, and coming in via stimulus checks and things like that, right? That's money coming into the economy. That's when you hear people say printing money, that's what it is, right? But they've been doing this throughout their entire existence, right? This monetary expansion that they're allowed to do, right? They were doing it even back in the 1920s. Bank deposits increased by 51.1%. Savings and loan shares rose by 224.3%. And net life insurance policy reserves jumped 113.8%. All of this occurred after the Federal Reserve cut required reserves to 3% in 1917, right? So when you cut required reserves for banks, then that means banks can lend more, which can increase the amount of money that is circulating in the economy, and that can stimulate the economy, okay? Now, by increasing the money supply and keeping the interest rates low during the decade, the Fed instigated the rapid expansion that preceded the collapse. Much of the surplus money supply growth inflated the stock market and real estate bubbles. After the bubbles burst and the market crashed, the Fed took the opposite course by cutting the money supply by nearly a third. This reduction caused severe liquidity problems for many small banks and choked off hopes for a quick recovery. Right? So what you see now in the United States is we are trying to recover from an economic downturn, right? And in doing so, increase the monetary supply, or trying to stimulate the economy in a lot of ways, right? But they did things completely backwards in the early days of the Fed. They had this expansionary monetary policy, right, where rates were low and a lot of money was in the economy and things got way too hot. Right. But then when things crashed, they were like, oh, well, we just need to do the opposite. Right. So what do? They tightened monetary policy. They raised rates. They did things like that. But in doing so, that makes the recovery from such an economic downturn even longer. And that's why you saw it last so long. That's why the per capita GDP was less in 1941 than it was in 1929. Now, as Ben Bernanke, who was a previous Fed chairman, has noted, right? He noted in his November 2002 address, before the Fed existed, bank panics were typically resolved within weeks. Large private financial institutions would loan money to the strongest, smaller institutions to maintain system integrity. This sort of scenario had occurred 2 decades prior during the panic of 1907. When frenzied selling sent the New York Stock Exchange spiraling downward and led to a bank run, investment banker J.P. Morgan, who is a real person, that's not just a name of a bank, stepped in to rally Wall Street to move significant amounts of capital to banks lacking funds. Ironically, it was that panic that led the government to create the Federal Reserve to cut its reliance on individual financiers like J.P. Morgan, right? So that is how the Federal Reserve came to be out of that 1907 panic, right? But it ended up leading to the Fed making bad decisions on the back end during the Great Depression, okay? Now, all that is very real. All that is very historically accurate. There were some, things with Herbert Hoover and some things with Theodore Roosevelt, and I'll jump into a couple of those things. But then what I really want to get to today are lessons that we can learn from the Great Depression. So stick around for that by the end of today's episode. Okay. Now, although often characterized as a do-nothing president, Herbert Hoover did take action after the crash occurred. Between 1930 and 1932, he increased federal spending by 42%, engaging in massive public works programs such as the Reconstruction Finance Corporation, RFC, and raising taxes to pay for the programs. The president banned immigration in 1930 to keep low-skilled workers from flooding the labor market. Unfortunately, many of his and Congress' other post-crash interventions, wage, labor, trade, and price controls, damaged the economy's ability to adjust and reallocate resources. Right? So things that he had done in the past did not allow the economy to bounce back well from the Great Depression. Now, one of Hoover's main concerns was that workers' wages would be cut following the economic downturn. To ensure high paychecks in all industries, he reasoned prices needed to stay high. To keep prices high, consumers would need to pay more. The public had been burned badly in the crash, and most people did not have the resources to spend lavishly on goods and services, nor could companies count on overseas trade, as foreign nations were not willing to buy overpriced American goods more than Americans were. Now, some of this sounds eerily similar, right? We're hearing a lot of things now about, there's too much money coming into the economy. We're seeing inflationary pressures, but, you have a Federal Reserve that says, well, we want to make sure that we can get unemployment down to a level that we want it to be at, and they don't really care too much about keeping rates low over a long period of time, right? So some of these types of things could occur again, right? Slow recoveries can continue to occur if the wrong decisions are made. Now, I'm not saying that definitely the wrong decisions are being made in the United States today. I'm just saying that some of these decisions don't sound way, way, way too different. Okay. Now, Herbert Hoover used legislation to prop up prices and hence wages by choking out foreign competition. Following the tradition of protectionists and against the protests of more than 1,000 of the nation's economists, Hoover signed into law the Smoot Hawley Tariff Act of 1930. The act was initially a way to protect agriculture, but swelled into a multi-industry tariff, imposing huge duties on more than 880 foreign products. Nearly 36 countries retaliated, and imports fell from $7 billion in 1929 to just $2.5 billion in 1932. By 1934, international trade had declined by 66%. Not surprisingly, economic conditions worsened worldwide. Right, so this was this protectionism of the United States and trying to keep everything in-house and just do things the U.S. way. That can be something that we still tend to fall into, right? But that led to a weaker worldwide economy. Okay, then when FDR, Franklin Delano Roosevelt, was voted into office in 1933. He brought along massive change in the New Deal. The New Deal he initiated was an innovative, unprecedented series of domestic programs and acts designed to bolster American business, reduce unemployment, and protect the public. It was loosely based on what we know now as Keynesian economics. Its concept was that the government could and should stimulate. Its concept was that the government could and should stimulate the economy. Okay, some economists claim that Roosevelt continued many of Hoover's interventions just on a larger scale. He kept in place a rigid focus on price supports and minimum wages and removed the country from the gold standard. Okay, so he forbid individuals to hoard gold coins and bullion. He banned monopolistic, some consider them to be competitive, business practices, and instituted dozens of new public works programs and other job creation agencies, and so tried to get us out of the mess that we were in. Now, the New Deal had some successes and some failures, but I'm not going to bore you with all those. Eventually, during FDR's time as president, and then obviously we worked into World War II, we did get out of the Great Depression, and we did begin to grow as an economy, especially in the wake of World War II. As we came out victors, we were able to grow as a country. But what can we learn from this? What can we find out from all of this history, right, that is relevant to us today? Right, and there are some things that I want to go through here that I think are very relevant to our daily lives today, and things that I've told you time and time again, but they are lessons that we can learn from the Great Depression. Number one, save for emergencies. Okay, We know the importance of saving for emergencies and having money set aside in case bad things happen. Now, coming on the heels of the Roaring '20s, a period of widespread prosperity following World War I, the Great Depression sent a shockwave through the country that most Americans were completely unprepared for. People who didn't have enough savings stashed away ended up broke, unemployed, and saddled with debt. So having emergency savings could have helped them there, and it can help you when you need it. Coronavirus hits, you lose your job, emergency savings can help you in that place. Okay. Then, second lesson that I think the Great Depression teaches us is you have to learn to do some things for yourself. Okay, during the Great Depression, DIY became the guiding principle. If you wanted something but couldn't afford to buy it, the best option was to make it yourself. Some people made everything from clothes to cleaning supplies at home. They even whipped up toys like corn husk dolls to keep your kids busy. If you're looking to save a bit of money during the pandemic, right, so that's where we are now, or just looking to avoid going to the store, you can find a ton of free tutorials online that will show you how to make all sorts of household things, right? And you can do a lot of things now via YouTube or any number of influencers that want to teach you how to do things on your own. And I'm trying to teach you how to do DIY finance, right? But people trying to teach you how to build things and how to maintain your home well, or build things for your kids, whatever it may be, right? DIY can really help you, and it can help you to save money and be prepared in a time of economic collapse and societal collapse where you can actually do things for yourself. The third thing I think we can take away from the Great Depression is that you should take steps to avoid debt, right? And this really falls at all times in all situations, but especially in these big financial crashes, right? The leverage is something that can just rocket things in a downward way, right? And that's not what we want. We want, to be out of debt. And if everything was working on cash, right, then it wouldn't accelerate growth, but it also wouldn't accelerate losses either, right? Because when it comes to debt, let's say for companies, right? If a company has debt and things are going badly and they can't pay their debts, well, not only are they hurting themselves, but they're also hurting the debt holders, right? They're also hurting those who hold their debt and are expecting payment, right? So it just magnifies and really makes larger the impact of these crashes. So take steps to avoid debt, and it'll help you in your financial life. Something else that we can learn from the Great Depression is to eat at home, right? Really save on your costs of eating out and going out and doing things that are unnecessary that you do not have to spend money on. For the majority of Americans in the 1930s, dining out was off the table, right? Practically every meal was cooked from scratch at home, and recipes of the day were creative, to say the least. Okay, while you might not be quite that desperate, making your meals at home and actually using up the food you've got in your pantry remains a sensible way to save money and can help you in times where things are really tight. Okay, then the fifth thing I think we can learn from the Great Depression is you can't be afraid to relocate. Okay, don't be afraid to move to somewhere where the opportunities are better. I think a lot of people get stuck in ruts. They get stuck in places where things are just so bad. And I know some people don't have the opportunity to relocate, but if you can, right, and if you do have better opportunities elsewhere and things are bad, then take advantage of the ability to relocate and go and follow dreams and do things that you expect will have the biggest payoff for you financially over the long term. Okay, then the sixth thing I think we can learn from the Great Depression is that you need life insurance to protect your family. Okay, being a parent can be stressful at the best of times, but the Great Depression was a new low. Not only was it hard to provide adequate food and shelter, but if something happened to you, your children would be left out in the cold without a dollar to their name. One of the saving graces for families during the Depression was life insurance, which provided liquidity during a time when even the banks couldn't. Cash value policies helped many families, and I tell you guys all the time that I'm not a big fan of cash value, that term life insurance is the best thing that we've got going today, right? But it can help you to protect your family, and it can help to protect your family if things are bad or if things are good or whatever. If something happens to you and they rely on your income, then they can still take care of themselves. The seventh thing I think that we can take from the Great Depression is that you need to learn to live within your means. And this was a huge thing coming out of the Great Depression that I think anybody who's got grandparents or great-grandparents or even parents who were quote-unquote depression babies, they have this willingness to keep things for longer than they need to keep them, or maybe be a little hoarder-ish, right? Have a little hoarder about them to where they keep things that they don't have to keep, and they use things they don't have to use for longer than they need to, right? And they really try to pinch pennies because they want to live within their means, right? Many Americans saw the economic growth of the Roaring '20s as an excuse to live outside their means. Okay, they purchased big ticket items that they really couldn't afford on installment plans, and they went into debt for things, right? Which was a strain on their cash flow then, and it's still a strain on your cash flow today if you're taking out debt, right? And they were not living within their means. That can really help you to do. I mean, I think if you just simplified finance, personal finance down, and you said, what's the one tip that you could give somebody to say, if you do this, you'll be financially successful. Maybe not perfect, right? But you will be financially successful. And it is live below your means, because if you live on less than you make, then you will always have some left, which is a great thing, right? Another thing I think we can learn from the Great Depression is that odd jobs are better than no jobs, right? A lot of people took on odd jobs because there wasn't a lot of work out there to do, right? And you see people do that today. People take on jobs being Uber drivers, and they do stuff online, and they build new small businesses, new side hustles, right? The side hustle came about, but the side hustle isn't new, right? Odd jobs have always been around, but they're just around now in a different way than they ever have been, and they're more available to us than they ever have been, and they can help us to jumpstart our financial life and keep our financial life afloat if anything negative is going on, okay? Then, another thing that I think can help us to learn from the Great Depression is that if you want to retire, right, and if you plan on having money one day, then it's okay to start small, but you need to start, and you need to start building up money for yourself. You need to start building up the opportunity to retire at the time that you want to, because if something exceedingly negative happens economically, right, don't be at the whim of the economy as to whether or not you can retire, or as to whether or not you can do the things that you want to do. Take your retirement into your own hands, and you'll be able to do so much more than you ever thought you could. And then the last thing that I think can help us, something that we can learn from the Great Depression, is that you need to help those around you. Help those in need. Help your community, because the Great Depression made everybody really rally around one another and ask each other for help, and try to get back on your feet the best way that you knew how, right? And if you have the means to help others, then you should help others. If you have the means to do things for others that other people can't, then take that. That is your blessing, right? That is, you've been blessed with the resources or the finances or whatever to do things for other people. Then absolutely do that, and that will be extremely fulfilling to you, and it will help other people to pass along the good deeds, and not rely so much on the government or rely on handouts, but rely on their community, building strong groups of people around one another that can help each other, pick each other up when they're down, and encourage each other towards meeting their full potential. I think that is a huge thing when it comes to what we can learn from the Great Depression. So that's the Great Depression, right? The Great Depression, it was a very sour time in the United States, and we still reference it to this day 100 years later, and there is no surprise as to why. But we need to learn from it. We don't need to just sit around and read these types of things in history books, or listen to me drone on about it in a podcast for 30 minutes and go, yeah, so what, right? Take something from this. That's why I tried to leave you with some lessons that you can learn from something like the Great Depression. Understand where it came from. Understand, how things today aren't way different than they were way back then, right? Even though life looks different, but the way that things were governed and the issues that we had economically aren't extremely different. And so we should really take things to heart and do the things we can to put ourselves in the best situation possible if something negative were to occur, or just in our everyday lives, what can we learn from something negative occurring? Because you can always learn from tragic events like the Great Depression. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about Black Monday, that financial crash that shook Wall Street in a very profound way and created rules on Wall Street that we still have to this day. So I think that'd be something really, really interesting for us to look into. And again, is another crash that we can learn from and not just push back into the history books until something similar happens and we go, oh, well, this looks a lot like that. No, learn from it in the first place, and then you won't have to repeat it on the back end. So Black Monday, that's what we'll be talking about in tomorrow's episode. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.